Everybody, in today's video, I want to talk to you about something that I see very often as a financial advisor. So every week I have people who come to me and they want my help to guide them as they transition from their working career into retirement. Now, so for some people, it's kind of a traditional retirement, in their 60s or something like that. And oftentimes it is for people who are in their 40s or 50s and they want to retire kind of earlier, have a work optional lifestyle. So as part of that process, I'll take a look at their financial information. One of the pieces, as you might expect, is to look at their investment portfolio. So over the years, as I have looked at probably hundreds, maybe thousands of different investment portfolios of individual investors, there's some common themes that I have observed over the year. And so a couple of those are just kind of top of mind for me. At the moment, I thought, hey, why don't I put a video together to share some insights about this? So a common characteristic that I see across people who are about to retire is a high concentration of their investments in a handful of stocks. And I usually see this, there's typically two ways that this comes about. One is at some point in their career, they started buying shares of, some of the big technology companies. And so, several years have gone by and now all of a sudden their shares of Apple or Nvidia or whatever have ballooned and are now a huge percentage of their overall investment portfolio. The other, and probably, I don't know, maybe more common way that I see high concentration of stocks in a retiree's portfolio is because they've worked for a company, they've gotten stock grants, RSUs, employee stock purchase plans, and because of that, they've now built up this huge concentration in that single company stock. Well, as we're transitioning into retirement, the objectives from an investment standpoint, they change as you might expect. And what you might expect is that having a bunch of your wealth in a couple of stocks is not a good idea. For those of you watching this video, you've heard about and about things like diversification. It's not a good idea to have all your money in a single company, that sort of thing. However, it's usually pretty difficult for somebody who has had great investment returns in a handful of stocks to go ahead and trade out those winners and trade them for something, I don't know, a little more boring, mediocre, less exciting, something that, looking back over the past several years, has not done as well as the stocks that I'm now recommending that they diversify away from. So I wanted to talk about this issue first. It's a very understandable concern for somebody in this situation. Frankly, like I said, it's really difficult to get rid of something that's done so well and helped you build wealth and gotten you to this place where you even have the option to consider retiring early or just retiring or, having a work optional lifestyle. And the second very practical concern is that usually there's tax considerations, right? You've had huge gains. And so it's not just as simple as pushing a button and trading it for this, for that, because if you were to do that, lots of times you're having to pay or recognize a lot of capital gains. And so obviously that has to be taken into consideration. So understanding those two concerns, the right answer is almost always going to be, even though those are legitimate concerns, the right answer is still probably going to be the need to diversify away into something else. And this brings us to the idea of diversification. Diversification is it is not a investment return maximization strategy. Diversifying your portfolio is a strategy to reduce, is a regret minimization strategy, right? Well-informed investors, you've probably looked at charts and you've heard all of these adages over the years of, hey, if you invest in the stock market, it goes up over time, and if it goes down, don't worry, your portfolio will come back, right? And you've probably experienced things like that. You just hang on and it's going to work out over time. Well, that framework of something that goes down and you have not the guarantee, but you have the high conviction and likelihood that that investment will go up over time, that framework does not apply to individual stocks. Because even though the market as a whole can go down and you can have high confidence that it'll go back up, that same logic does not apply with individual stocks. And so once you're retired, even though your individual stocks have made you, perhaps you've been fortunate and they've made you very wealthy, now it's the time to change the framework and think about what needs to happen so that I can stay wealthy. Diversification is about regret minimization, not about return maximization, okay? So, with all that being said, it's difficult to do, and the way that you transition out of individual stocks into a diversified portfolio is something that has to be done very thoughtfully. Um, and I mean, the name of the game there is tax planning. And as an early retiree, very most often there are other considerations that are very important to an overall plan. Things like qualifying for health insurance subsidies, Affordable Care Act, tax credits, and as well as using other tax planning strategies. So obviously the way that you kind of adjust your portfolio and get it into maybe kind of ideal shape for retirement is something that you don't just do. It needs to be thought out, and there's trades off. There are trade-offs. And so anyway, something that's been on my mind. I thought I would share it with you. If you are getting close to retirement, congratulations, and hopefully you found this helpful. I'll catch you next time.